Dear students, Assalamu alaikum wa rahmatullahi wa barakatuh. I hope everybody is doing well and in good health. Today our topic of discussion is company liquidation. As you know, in the last lecture we have covered the partnership liquidation, where you have learned practically how to liquidate a partnership business and what are the steps involved and what are the accounting treatments of each and every step. So today we are covering the company liquidation. And what do we mean by the company liquidation? So dear students, the company liquidation is the process of liquidating or dissolving the limited liability company. So again we are having liquidating or dissolving. So simply by liquidating or dissolving we mean to sell out the assets of the company and to redistribute them into the creditors and shareholders. But in the company liquidation, we are talking about the limited liability company. So dear students, what do we mean by the limited liability company? Okay, limited liability company. So if you remember, we have a limited liability and we have unlimited liability. In the case of the partnership business, we had unlimited liability. Under unlimited liability, the partners and investors must pay the liability of the company, must pay the creditors. Or in other words, under unlimited liability, the partners must compensate the losses. Even if their current resources are not sufficient enough to pay the losses or the creditors, then they have to manage it out of their own resources, right? And that is what we mean by unlimited liability. But today here in this example, we are talking about the limited liability, where the liability of the shareholders and investors are limited up to their investments, right? For example, you are an investor in one of the company and the value of your investment is $20,000. Then keep in mind, your losses in this company will never go beyond $20,000. So that's limited up to your investments, even if the company 100% goes in losses. And that is what we mean that by limited liability. So all shareholders in the giant stock company or corporations, right, they have limited liability. Okay, for the purpose of company liquidation, you should know what is bankruptcy. So dear students, bankruptcy is the legal status, right? It is the legal status of a person or other entity. Entity means business, right? Organization or company that cannot repay the debts it owes to the creditors. So simply, dear students, bankruptcy is a legal situation or legal status of a business when it faces, right? And what is in this status? That the business cannot repay the debts. Whenever the current resources of a business are not sufficient enough to pay the liabilities or the current liabilities, so technically we say the business is insolvent. Insolvency is a situation whenever the current liabilities of a business are higher than the current resources. So in simple word, whenever a business become insolvent, so we say the business cannot pay the current liabilities, right? So bankruptcy is a legal status of a business when it cannot pay the liabilities or debts. Okay, I hope you got it. So a decision must be made whether to dissolve the firm through liquidation or to keep it alive through reorganization. So dear students, at the time of bankruptcy, right, businesses have two options. One is a reorganization and another is liquidation. In reorganization, the business is brought back into the life. In this situation, mostly governments help and provide some funds and assistance to businesses to keep them running, right? So in the reorganization, sometimes the structure of the business is changed or it is merged with another company. So that is the first option, just to bring the business back into the life, to continue the operations of the business. But in the second options, we have liquidation. In the liquidation, the business is closed. It is winded up, right? So In our today's lecture, we are talking only about the liquidation, how the company or the joint stock company is liquidated. So in this example, we have a company by the name of Chief Land Incorporation balance sheet, right, before liquidation. And the values divided by 1000, it means all the values we have here, right, with 3 zeros. It means this is not 80,000, this is 80 million. Just to make it simple and to make the value smaller, just divided by 1000. So look into this example. We have 90,000, the whole amount of assets of this Chief Land company. But how much is the claim? $90,000. It means we are liquidating this $90,000, right? And whatever cash we are receiving, we are distributing them on these individuals. So all these individuals provide fund to the business. So obviously, when you sell a business, the cash should be given to these individuals. So how much to be given to each and everyone, right? And who should be given the preference? Okay. So that is what actually we are learning here in this topic of liquidation. So dear students, I have made it very much simple. The whole chapter I have just concluded in this one presentation. Look here. We have one table here, and if you see, by the name of priority claims. What do you mean by priority? It means just we need to know who should be given preference, who should be given first, whose claim should be satisfied first, and then second, and then third, in this way. So you can say the whole process of the liquidation is led by this table. If you learn these steps, right, inshallah, you will easily liquidate the company liquidation. So the whole liquidation is all about this table. So in this table, all the creditors, all these are the you can say all the individual who provided loan to fund to the company, right? We divide them into two groups. One is called secure creditors and general creditors. Okay. So dear students, secure creditors are those creditors, right, whose claims are satisfied first. It's been once the secure creditors' claims are not satisfied, then we are not giving to general creditors. Okay. What do you mean by claim? Claim means the right they have. It's been each and everyone is having a claim. How much is the claim of, for example, accounts payable and notes payable, right? This is what we mean by claim. So we should pay to secure creditors first, right? Then we should pay to general creditors. Okay. So dear students, who we have in the first group, right, which is the secure creditors, is the first and second mortgage, right? It means we should pay this first, and then we should pay the trustees cost, and then wages if there are wages dues, and then taxes we have to pay, and pension plan. And I'm explaining each and every one. Okay. So first, dear students, you should know what is mortgage. Okay, the mortgage loan we should pay first. So what is mortgage? Simply, the mortgage is a loan which is acquired for the purpose of purchasing real estate, right, like land, or sometimes to construct a house. So the real estate which is put, right, usually which is put as a security for this loan, right? So the loan which is acquired for the purpose to purchase the land or a house, right? And then that land again is just put as a security for that loan, and this is what is called collateral. So what do you mean by collateral or security? For example, if you or any organization who acquire a mortgage loan become default or unable to pay the liabilities back, then the lender is having the right to sell out your collateral, right, or the security, and to recover their liabilities and to recover their amount or the loan they have provided you. So dear students, we have first mortgage and second mortgage. So what do we mean by first and second mortgage? For example, you have acquired loan and you have put the land, right? You have purchased, or you have a land, you have put the land as a security for the first mortgage. The mortgage, the loan you have acquired, and you have put the land as a security, right? So we say the first loan you have acquired using the same collateral, the land, right, is called the first mortgage. But sometime you may acquire another loan, right, or number of loans, right? So the second loan you are acquiring and putting the same land as a security, or the portion of the same land as a security for the second mortgage, right? Then that mortgage is called second mortgage. So simply, you may have a land, and by the help of that land you have acquired one loan, and second loan, and third loan. So the first loan you have acquired and you have put the land as a security, right, it's called first mortgage. And the second loan you have acquired and you have put a portion of that land as a security is called a second mortgage, and a third loan is called a third mortgage, right? So simply, what's the difference? The first mortgage is having the preference in the claim, right? Means the first mortgage is having the priority over the collateral. It means in the liquidation or in default situation, you have to pay the first mortgage. Once the first mortgage is not satisfied, then the second mortgage cannot receive, right? And then the third mortgage. So that is what we mean by the first and second mortgages. So dear students, if the businesses have the first and second mortgages, then they should be paid first before everything. But a point we have. What is the point here? The point is, for example, the land which is put as a security for first and second mortgage is sold in the market, right? And whatever the value we are receiving from that land, right, out of that value we are paying the first and second mortgage, right? We are not paying the first and second mortgage out of other resources we have. Only out of that collateral we have sold. We are paying the first mortgage in the secure creditors, okay? Yes, we are paying the rest of the value of the mortgage which is not satisfied here in the secure creditors, in the general creditor. But a portion, right, which is satisfied here in the secure creditor is only the value of the collateral, okay? You have sold the collateral, you have sold the assets in whatever value realized to be given to first and second mortgage in the secure creditor, and whatever claim which is not satisfied in the secure creditors, so the first and second mortgage will come and get their remaining claim here in the general creditors. So I hope you got it. Now we are just coming into the second one, which is the trustees cost. Who is the trustees, dear students? Trustees or trustee is actually the third party, right, who is administering or who is leading the whole liquidation process, right? So why the third party is called trustee? Why? Because the shareholder and the creditors, both of them, they trust on the third party, and the third party is playing a role and leading the whole process and how to administer this liquidation, okay? So the trustees, the trustee, we have that is having a cost. We should pay them some fee, and that is called trustees cost. So in the second step, we should pay the trustees, and then if there are wages due, right, then we have to pay the wages, and if there are taxes due, then to be paid. And lastly, in the secure creditor group, we have to pay the pension, right? Why? Because if there are some employees who are at the stage of the retirement, then if there are some pension liability due, then you should pay them in the secure creditors. And once the secure creditors claims are satisfied here, then we are coming into the general creditors, okay? So dear students, look here, we are having two tables. This is the first one and this is the second one. In this table, we are just making a payment to secure creditors, right? In the second one, we are making a payment to general creditors. So look how we are doing it, okay? Okay, so in this distribution of proceeds on liquidation, first we have proceeds from sale of assets. Okay, so look, dear students, proceeds from sale of assets. Look here, we have proceeds from sale of current assets. How much the current assets? We have $80 million. Okay, and $80 million, this is the current asset. Okay, we are selling the current asset in the market, and we are realizing how much? $41,950,000. Okay, how much is it? Means we are almost losing 50% here. 80 million and 41 million. Okay, and proceeds from sale of fixed assets. How much is the value of fixed assets? We have 10 million, but how much we are receiving here? 5 million. Almost 100%, 50% losses we have here. Okay, so you can say the total receipts we have is $46,950,000, right? Means $90,000, right? We are liquidating and realizing how much? $46,950,000. So what we should do here in the first step, equal sign and click on $46,950,000. It means this is the proceeds from sale of asset. This is what we are receiving from the total assets we are realizing, we are selling in the market. Okay, so dear students, the second we have first mortgage. Now we are following this table exactly. Okay, look, we are paying. Why? Because in this table we are making payment to whom? To secure creditors here. So we are paying first mortgage now, and then we have to pay the second mortgage. Okay, so first mortgage paid from the sale of fixed assets. Okay, dear students, in the whole amount. Why? Because in this amount we have also fixed asset, and how much is the value of the fixed asset? 5 million. So it is said first mortgage paid from sale of fixed assets. It means we are paying from the fixed assets. Okay, how much is the value of fixed asset? That is 5 million. Okay, how much is the claim of the first mortgage? Look here in this table in the balance sheet. The first mortgage claim is 6 million. Okay, and how much fixed assets we have? That is 5 million. It means out of this 5 million we cannot fully satisfy the value of the first mortgage. Why? Because the first mortgage is 6 million. It means we can only give here the first mortgage only 5 million. How much? 5 million, this amount, not more. Why? Because as I have explained here, the first and second mortgage should be given here in the group of secured creditors out of the value of the collateral realized. So how much value out of the collateral realized? 5 million. No matter if the claim is higher, but we are not paying them here. Okay, we are only paying them 5 million. Okay, now we are coming into the first mortgage we have paid. Now we come into the second mortgage. Okay, keep in mind, dear students, the second mortgage is receiving nothing here in this group. Why? Because the first mortgage has not yet received the full amount. The claim of the first mortgage is 6 million, but the first mortgage is receiving only 5 million. It means for 1 million of the first mortgage, right, which is not satisfied, the first mortgage should be given in the general creditor here. So as you see in the table of the general creditor, we have the first unsatisfied portion of the first mortgage, and that is how much? 1 million. Why? Because 5 million of the first mortgage satisfied here, but the 1 million which is remaining, so that is coming into the general creditor. So the second mortgage 1 million automatically is coming here. Why? Because in the first group, which is the secure creditor, only out of the collateral value the first and second mortgage will receive, and the first mortgage is having the first priority or the preference. So that is why as per the preference, the first mortgage is receiving 5 million and the second mortgage is receiving nothing. Okay, now after this we have trustees' cost to administer bankruptcy. So dear students, look here, we have fee and expenses in the notes. The fee and expenses, that is given 6 million. This is the cost of the trustees. So we are paying the cost of the trustees, and that is equal to how much? 6 million. So equal sign, and just click on $6 million. So dear students, just make it clear, all these values we have are in dollar, okay? Just to make it simple, I have made all these values in dollars, okay? So look dear students, we have paid here the first mortgage, and we have paid the expenses, right, which is, as you can see here, the expenses, the trustees expenses, what we mean by 6 million, right? Okay, next we have the fourth, we have wages due workers earned, right? Wages due workers earned within 3 months prior to filing of bankruptcy petition, okay? So now dear students, look here how much wages we have. The wages, okay, in the third step, as you can see here, we have paid the first mortgage, and trustees we have paid, and now we should pay the wages. Okay, how much are the wages? Check here. Okay, we have $700,000 with 30. It means $700,000, right? So we are paying the wages now, and how much is the amount of wages? Equal sign, and just click on 700,000. So just write $700,000. Okay. Next we have taxes. How much are taxes we have? This is, look, we are just following this table. So how much are taxes? You can see. So dear students, the taxes we have US taxes, right, which is 1,000, and we have state taxes, which is 300, right? So federal taxes and local taxes, total we have, if you add them, 1,300. So within 1300,000, right? So we have 1300,000. This is the total amount of taxes. Okay, next we have unfunded pension liability. So dear students, look here, we are following this table. So we have pension liability next. So dear students, we have funded pension liability, and we have unfunded pension liability. So you should look into the balance sheet. If you can see any liability of the pension, then it's okay, and the funded pension liability is mentioned in the balance sheet. What do we mean by the funded pension liability? Simply, whenever a business is retaining a portion out of revenue, a fixed percentage out of the revenue, and just keeping it as a provision, right? And out of that, the pension is paid, right, at retirement. So that is what is called funded pension liability, and for that we have a provision, and you can see it here in the balance sheet. If the company is having the funded pension liability, then you can find it in the balance sheet. But another type of pension liability we have is unfunded pension liability, and that is whenever the company is not keeping any provision, and directly out of the revenues of the company is paying to the pension holder or at the retirement. Okay, so that is called unfunded pension liability. So unfunded pension liability is not shown in the balance sheet. So simply, first you have to check the balance sheet. So if there is any liability, right, then it's okay. If you cannot find any liability in the balance sheet, then you have to check the notes. We may have unfunded pension liability. Why? Because unfunded type of pension liability is not shown in the balance sheet. So in our example, we have unfunded pension liability, and that is how much? That is $15 million. Okay, $15 million. Okay, so now out of $15 million, how much should be paid the pension here in the secured creditors? How much should be paid here unfunded pension liability? So dear student, in the situation of bankruptcy, if we have a pension, So the businesses have some discretion in payment of the pension, right? For example, if we have a 15 million, right, 15 million pension, then the business may not necessarily pay the whole amount of pension in the secure group or in the secure creditors group, right? Why? Because businesses having some flexibility and some discretion to pay a portion of pension liability here in the first group, and the remaining portion should be given where in the general creditors. So depending on the policy of the company. So in our example, how much of $15 million is given to secure creditors, right, in this group? Okay, very much easy. Look here below the notes, this is given unfunded pension liabilities have a prior claim of 30% of total equity. Okay, the company says 30% of the total equity should be given, right, what as a pension liability where in this group. Okay, so let's compute how much should be the 30% of total equity. Okay, so look dear students, we computed here. So equal sign, how much total equity we have? 43 million. So 43 million multiply with how much? 30%. So 30% is 0.3 is equal to how much? $12,900,000. It's mean we can only pay the pension here how much? That is $12,900,000. So it means the remaining should be paid where? In the general creditor. So equal sign, out of 15 million subtract this value, how much is remaining? That is $2,100,000. So you can say this portion is given in secure creditor group, right, and this portion is given in general creditor. Okay, so let's pay. So just click here, equal sign, and we have $12,900,000 we are paying here, right? Okay, now dear students, what you should do now, you have to add sum all these values, right, is equal to how much? This much, $25,900,000. So it's mean out of $46,950,000, which is the total cash receipt, we have $25,950,000 we paid to whom? And to secure creditors, right? The first group we have paid to them. Now who are remaining? Now the general creditors. Okay, so dear students, okay, who we have in the general creditors? Very much easy. So look in the balance sheet, accounts payable we have not paid, notes payable not paid yet, wages we have paid, taxes we paid, and secure creditor, current liabilities, right, this is total of current liabilities. Then we have first mortgage, we have paid a portion of first mortgage, and the second mortgage we have not yet paid, right? Then subordinate debenture we have not paid. Clear? So very much simple and easy. Just you should look here in this table, right? We have paid the first secure creditors, and whoever is remaining, we just bring the name and just mention it here in the claim of general creditor. Like if you remember in the first mortgage portion which is not satisfied, we mentioned, and then the portion of the second mortgage, bring it in, just write it here. In the notes payable, how much we have? 10 million. Look into the notes payable, 10 million we have. Accounts payable 20 million, we brought it here. In the subordinated debentures, look here, we have the value claim of 8 million. And the pension plan which is remaining. Why? Because total we have 15 million. Out of 15 million, 12,900,000 satisfied here. So how much is remaining? $2,100,000 here, and that is what we have mentioned here, $2,100,000. Okay, dear students, if we just look here into the total claim of the general creditor, which is 42 million, but how much is the available fund? But before to talk about this, keep in mind, in this table we are not having the preferred stock in the common stock claim. Why? Because this is only for general creditors, and the creditors are those individuals who provided loan. So the preferred stock and the common stock, they are owners, and the fund, their funds is not treated as a creditor fund. Okay, so that is why for the common stock and the preferred stock, we are not having any place in this table. Okay, so it means once the general creditors are 100% satisfied, then whatever is the remaining, right, that is received by the preferred stock first and then the common stock, right? So that is why we just look, right, we see at the end if there are any value left out of the general creditors, and then we are distributing them into the preferred stock and the common stock. Okay, so dear students, the total claim of the general creditor we have is 42 million, and here we have 21 million fund is remaining. So it means the fund is way more less than the total claim. So how much we can give to all these individuals, we need to compute the application percentages, right? So how much is the application percentage? And as you can see, 21 million is 50% of 42 million. It means we can only give to each and every individual for 50%, and have this 50% is computed so much easy. So look here, dear students, you have to compute application percentage, right? And this is equal to equal sign the available fund, which is 21,050,000, divided by how much is the total claim of the creditors, and that is 42,100,000. So you can say, and if you multiply this with 100, so this is equal to how much? 50%. Okay, so it means if you divide 21 million over this value is equal to 50%. This means simply that all creditors can receive only 50%, because the fund is 50% of the claim. So compute the 50% of each value, multiply this value with 0.5 to compute the 50%. So 50% of this 1 million is equal to 500,000, and just drag it down, and then you can see, right, the 50% of this 1 million, which is the second mortgage, is 500,000. So it means the first mortgage is having a claim of 1 million, can only receive 500,000, 50%. And also the second mortgage, the third mortgage, is receiving 5 million, because the total claim is 10 million, and this is out of 20 million, 10 million is received by accounts payable, and 4 million by subordinated debenture, and pension is how much? Because 2,100,000, which is received by how much? 1,050,000. Okay. So dear students, look, 50% we have distributed to all of them. But here we have another column by the name of after subordination adjustments. So what do we mean by subordination adjustment? In our example here, in a question it is given, right? What is given? That the debentures, we have debentures. You know what is debenture? Debenture is actually the least secure type of the bond. This is a type of bond which is not secured, or this is less secured, right? So in our question, in this example, it is said that the debenture is subordinated to notes payable. This debenture is subordinated to what? Notes payable. What do we mean by this? It means if the notes payable is not 100% satisfied, then the debenture is receiving nothing. Once again, I'm just repeating. If it is given in a question, right, that the debenture is subordinated to the notes payable, right? For example, like this. Mention like debenture is subordinated, right, to the notes payable statement is given like this. Debenture is subordinated to the notes payable. We mean by this that if the notes payable is not 100% receiving, then the debenture will receive nothing. Simple as that. Okay. So now we have this column of adjustment only for notes payable in subordinated debenture. So what we are doing, look into the claim of the notes payable, which is 10 million, and how much is received by note payable, right? 50%. It's mean way more or less 50%. So it's mean the debenture which is received by debenture 4 million should be given to whom? Should be given to notes payable. Okay, should be given to this 4 million should be given to notes payable, should be added here. So once it is added, so you can see equal sign of 5 million, right, plus 4 million. This 4 million should be taken from the debenture. So we will have notes payable 9 million. Still it is not 100% satisfied. So the debenture is receiving 0. Okay, I hope you got it, dear students. Once again, let me revise it. We say the debenture is subordinated to the notes payable. It's mean if the notes payable is not 100% satisfied, so the subordinate debenture will receive nothing. So that is why the subordinate debenture is receiving 4 million here, and notes payable 5 million, which is not 100%. So we are just taking the 4 million and adding it here, so is equal to 9 million. So if, for example, the notes payable value was 7 million here satisfied, so we are just taking 3 million out of here, and then 1 million is receiving remaining for subordinated debenture. But in our situation, here is the 5 million deficit. Okay, so that is why the 4 million, the whole amount is just going here and added with the notes payable. I hope you got it. So this adjustment column is only for what? That is for the adjustment of subordinated debenture and notes payable. So the rest values are same. Why? Because there is no adjustment, right, in any other value. Okay, you got it. In the last column we have percentage of original claim. Dear students, you have to compute, you should compute how much each and every individual is receiving here. Means how much percent of each and every creditor satisfied. So very much easy. We have first mortgage. How much is the total claim of the first mortgage? The total claim of the first mortgage is 6 million. Okay, first mortgage is receiving in the secure creditor group 5 million, and how much is receiving here? Just look in the last column, 500,000. So 5 million plus 500,000, so equal sign 5 million here plus 500,000 in the group of general creditors, right? And the whole should be divided. Okay, just take it in the bracket, 5 million, right, plus 500,000, and the whole value should be divided by the original claim. How much is the original claim? That is 6 million. So divided by 6 million, that is equal to 92%. It means the first mortgage claim of 92% is satisfied. 92% portion of the total value, the original value of the first mortgage satisfied here. Okay, now how much portion of the second mortgage? The second mortgage total claim we have is here, that is 1 million, and how much satisfied? 500,000. So equal sign 500,000, which is the satisfied portion, divided by how much? 1 million. So 50%, right? And how much notes payable satisfied? 9 million out of 10 million. So 9 million, click on 9 million, divide by 10 million, it's mean 90%. And how much discount payable is 20 million, and 10 million satisfied, so 10 million divided by 20 million, so is equal to 50%. And then we have subordinate debenture. How much? Okay, this value is 0. Okay, very much sorry for this. Why? Because mistakenly this is 0. Why 0? Because if you remember, from the 4 million, this 4 million is going here, and we have added 9 million, so it's mean the subordinated debenture is receiving nothing, 0. So equal sign, and this satisfied portion divided by the total claim. So again the answer is what? 0. Okay, and now we have 1,050,000. The total claim of the pension is how much? 2,100,000. So equal sign. Okay, dear students, how much is the original claim of the pension? So that is, as you can see here, the unfunded pension liabilities total claim is 15 million. Okay, and the 15 million, how much satisfied in the group of secure creditors? 12,900,000. And how much here? 1,050,000. So you can say the total value satisfied 12,900,000 less 1,050,000 here, and to be divided by original claim. How much is original claim? That is 15 million, equal to 93%. So dear students, once again, please be attentive into this point. Okay, in this, after subordination adjustment, the subordinated debenture is receiving 0 value, nothing. Why? Because we have transferred the value of the subordinated debenture, and we have added with the notes payable to make it 9 million. So this column is only for these two individuals. Okay, let me simply tell you that if, for example, the total value here of the notes payable is 8 million, means from 10 million 8 million satisfied, then you would take from this value only 2 million is just going here to make it completely 10 million, and 2 million is then in that situation remaining for the subordinated debenture, right? So I hope you have learned what is the company liquidation. So here in this question, or this example, as you see, the preferred stock and the common stocks, right, they are receiving nothing, right? The owners are receiving nothing. Why? Because even the general creditors 100% claim is not satisfied. Okay, so as per this table, as you see, we have paid to all these individuals who are secured creditors, and then we have paid into general creditors. So the portion of unsecured loan, the portion of unsatisfied loan. So unsatisfied means the loan which have been not satisfied in the group of the secured creditors. So if you remember the first mortgage and the second mortgage, which we would pay to them and the secured creditors, but unfortunately because of the lower value of the collateral, their claim not satisfied fully here, so that's why we brought them here into the general creditor, right? So that is why the unsatisfied portion of the secured loan we have paid here, and then notes payable we have paid, and accounts payable, subordinated debenture if you remember, and also this column is for subordination adjustment. And the last value we have unsatisfied portion of the plan. If you remember the pension plan, we have paid that some portion satisfied here and the remaining satisfied here in the general creditor. Okay, dear students, I hope you got how to liquidate the company, right? And if you have any question, so you can ask me in the group, right? Okay, have a nice time and good luck.